the last 10 years, as you know, we've experienced ultra-loose monetary policy that has resulted in significant distortions in global markets and given rise to that environment that is likely going to lead to negative asymmetry to equities, and especially long-duration equities that are priced off these low-yielding bonds. And a prime example that we've seen in the recent years are US equities. If you're looking at the chart over here, the blue line on this chart shows you how they've decoupled from equities in the rest of the world. And it wasn't just emerging markets like South Africa that haven't enjoyed all the spoils of that bull market since 2009, but global equities generally. It may surprise you, but if you're looking at markets like the UK, where the FTSE 100 index is in fact down 28% in US dollar terms since 2007 from its peak, or the CAC 40 in France is down 26% in US dollar terms. And also emerging markets generally, they've actually been in the bear market from 2011 to 2016. And yes, we did see a nice recovery in the last 2 years. The performance this year almost puts them back into bear market territory again. But I think it's important to step back and take measure of the valuation backdrop that we're dealing with here. On some measures, and there are plenty more, on some measures like on the chart here, the Schindler price earnings ratio, the S&P 500 index is at the most expensive valuation levels since prior to the Great Depression and .com in 2000. So at PSG Asset Management, as you know, we are bottom-up investors, and even in that backdrop, we continue to find opportunities in the US. But generally, we've concluded that the US market is an example of negative asymmetry and at best offers poor returns, long-term returns going forward. This chart over here shows you the relative price-to-book ratio of the cheapest quintile of global stocks and compares it to the most expensive 20% of the market. And what you can see on this chart here, that the valuation gap across global stocks is currently still as wide as it was during the extreme environment of .com, and is indicative to us of the potential for mispricings that are available in markets. And at PSG Asset Management, as you know, we like to shop in the cheaper parts of the market where we think we can find that positive asymmetry.